Hey guys, this is a video to go over the 3 practice questions I have on Chapter 13. Kind of questions you expect to see on an exam. So again, with these, I really recommend try them on your own first. Then look at the solution that's provided on all of them and see if you can figure out where you went wrong. And then as a last resort or as further review, listen to this video. So if you haven't, give it a try first before you listen to this, and then you'll have a better idea where you're at. So this one is called the sample exam question, and it is a warranty question. Pretty standard, a few extra words in it, and a few things I wanted to highlight. We sold 400 computers at a unit price of $2,500, so a warranty question is always going to have a sale of something. There's a warranty cost. Now in this one, instead of saying a lump sum amount or an amount per unit, it's got an amount per unit broken into parts and labor. Again, that's kind of extra wording. Your warranty liability is going to be 400 computers times 155 plus 185, right? So just kind of read through the question, figure out what the warranty is, and then watch the dates. This one says, for simplicity, assume all sales occurred on December 31, 2015. That just means no time expired in 2015. So if we need to amortize anything then nothing would happen in 2015. Some questions will be January 1, in which case you've got a year of activity. Some might be evenly throughout the year, in which case you've got half a year. Okay. Warranty sold separately from equipment, and we incurred some warranty costs. So part A is expense type. Which means we just need to accrue all these warranty costs, the 400 times 155 plus 185, and set up an expense. And because matching, we need to get the warranty expense in the same year we're recording the sale, which is 2015. And in 2016, I'll walk through where we incurred warranty costs. Part B, though, now we're doing the revenue type approach. And the only thing I really wanted to highlight here is you need a value. So you're going to always see something to that effect. Comparable warranties can be purchased for 400. So that means that the customer, when he bought this, didn't pay $2,500 for a computer. They paid $2,100 for a computer, and they paid $400 for a warranty. And this warranty has a 2-year life and will recognize revenue over 2 years. But we won't recognize any in 2015 because we're assuming everything was bought December 31. And then part C is just a question, give some thought to in a few words as to what do you deal with your expenses off. So I'm not going to go through the whole solution. Just real quick, 2015 we record the sales and we record all of the warranty expense related to those sales. 2016, when we actually incur costs, it comes out of the liability. So if our estimate of the liability is perfect, which it wouldn't be, but if it was, we would have no revenue and no expense after 2015. Everything's been recorded in a year of sale. Part B, where we're using the revenue approach or the service method. Again, we break the sales down between warranty and computer sales. And the warranty revenue is all unearned because it all starts in 2016. And in 2016, we recognize one of the 2 years worth of warranty revenue and we record the warranty expenses. So when we're using the service type approach, we do have revenue and expenses in future years. So again, the assumption is we sold this warranty to make money. It's just another product, which, truthfully is certainly what extended warranties are. They're very profitable for companies. And in part C, it says, what if the estimate's wrong? And again, just a few words. Watch on an exam if you get a question like this. If it's worth 1 mark, it's not a paragraph. It's a sentence, maybe 2. So in this case, what if the liability's wrong? As soon as we know it's wrong, we'll fix it. And we'll record any additional expense or reduce our expense at the time we realize it's wrong. Okay? There's another warranty question there called another warranty question. Same type of thing, so I welcome you to go through it. This one, we assume all the sales occurred January 1st, I believe, so all that means you're going to have a year of amortization in it. So go through that, basically exactly the same as the first one. Part C, I did want to highlight. In this one, we're asking what's going to show up on our financial statements. And that's a fair question for the exam. You'll probably see a question like that, maybe not on warranties, but on something. Because it's important that you realize as you do entries and calculate things, you should know where that's showing up on financials. So here, where does a warranty show up? And really, you just have to go back to your accounts. Where did you book entries? And know what statements those entries show up on. So on the income statement, I'm going to have any revenue and any expenses. So in this case, I've got the sales of the product, I've got warranty revenue because this was a service type, and I've got warranty expense. On the statement of financial position, I've got whatever's left in my unearned warranty revenue account. Okay, so again, just as we're going through the various chapters, be comfortable you know where they sit on the financials. And one last one is a premium question, which again we will do in class. Very similar concept. We just want to look at a transaction. We want to record all expenses related to a transaction at the time of the sale to match. Or if we're deferring it and using the service type approach, again, we want to match the service type in the future. So this is box tops. And if you read through, customer sends in some box tops and a couple of bucks and they get a doll. Again, I think the key thing in your logic here is just understand you need to match everything and record all your expected expenses. So in part A, we need to figure out what's the warranty or the premium program going to cost us. And that's what the math goes through is, how many of these dolls are we going to have to give away? And those dolls have to be bought. That's the first entry. We've got all our sales. And we want to accrue the liability because we want to expense all these dolls at the time of sale, so this year, and we create a liability, and then as we issue these dolls in the future, it'll come out of there rather than expense. And if you see the redemptions, when customers send in box tops, they send in $2, so that's the cash. We send them a doll, so that's the doll inventory, and the difference comes out of our liability. Right? The doll costs us $4.50. The customer sends us $2, so we have a net liability per doll of $2.50. Revenue approach, again, identical to warranty, just different account names. In this case, we're basically saying these box tops, we are selling them, and we will recognize revenue as they are redeemed and we provide these dolls. So if you kind of follow through with that logic, right? When I sell the cereal, I've got unearned revenue, i.e. same as unearned warranty. When I redeem these things, I'm actually going to recognize the revenue from them and recognize the related expense. Okay, so those are 3 pretty good exam type questions. There will be a practice exam with some more. Hopefully that helps. Any questions, you know where to find me. Thanks all.